When GTA 5 was released, it made over 1 billion in sales in just 3 days. The question is, could GTA 6 break those records again? Welcome to Investing Edge with Eric. In today's video, we'll analyze Take-Two Interactive, the parent company of Rockstar Games, to see if the stock is undervalued despite rising roughly 40% in the last year. I've gathered 5 years of financial data and also modeled 10 years of future financial performance to answer just one simple question. Is the stock undervalued, or are investors already pricing in the hype? To answer this question, we'll go through 4 key sections, ending with an estimated annual return, a fair share price of the stock, and a final rating of the company. And if you stick around, I got a free bonus to help you assess this stock even further. So let's dive in and start with a brief intro to Take-Two Interactive. What is it that they actually do? So Take-Two Interactive is the owner of not only Rockstar Games, but of 3 gaming studios. It's Rockstar Games, it's 2K, and it's Zynga. We'll go through them just quickly one by one just to see the type of games that they actually produce and develop. Okay, so let's start off with Zynga. This is actually the newest kid on the block. It was a recent acquisition by Take-Two Interactive just a few years ago, and their focus is on developing mobile games. According to themselves, roughly 10% of the world's population interact with at least one of their games on a monthly basis. And this was actually a diversification play by Take-Two Interactive. Previously, they've been quite dependent on Rockstar Games and on 2K to bring in the revenue. Now they have a third gaming studio that is established across the world. So the second gaming studio that Take-Two Interactive owns is called 2K. They are, unlike Zynga, focused more on console and on PC gaming. And a few of their big titles include, if we look at the list, such as Borderlands, we have Civilization, quite a few sports-oriented titles such as the NBA and PGA Tour, etc., etc. But if we move on to the crown, the jewel, or the focus of this analysis, it's Rockstar Games. It's the biggest gaming studio by far. The reason why Rockstar Games is the biggest and most important part of Take-Two Interactive is because of 2 major titles. It's the Grand Theft Auto series and it's the Red Dead Redemption series. As many of you may know, Grand Theft Auto GTA 5 is one of the most successful gaming franchises of all time. The series debuted in 1997, and since then Rockstar Games has released 5 major titles, the latest one being GTA 5 releasing in 2013, nearly 12 years ago. Another popular gaming franchise that Rockstar Games has developed is the Red Dead Redemption gaming franchise. The latest game, Red Dead Redemption 2, was released in 2018, which we'll also discuss in the analysis. But just to reiterate, the focus will be on Grand Theft Auto 6. If we go to the second part of the video, being the financial analysis, we'll go through some historical data of the company from the previous 5 years. In doing that, and to get the outputs that I discussed in the intro, being the estimated annual return, or the IRR, and the fair share price, we'll have to, first of all, calculate the enterprise value price target. We'll also calculate the free cash flow to equity price target, and we'll also do a discounted cash flow analysis. So here we are in the model itself. The enterprise value data relevant for us is here at the top, in this top table, and we'll look at each key metric one by one. If we start with revenue, we have the data from 2020 to 2024. We can see it's kept, it's quite resilient. It's grown at 15% every year on average. We can see a big jump though from 2022 to 2023, and that was the acquisition of Zynga, which I mentioned before. If we look at the EBITDA, we can see here it has also stayed quite resilient. But in the last year, or 2024 fiscal year, it dropped significantly. This is of course mostly due to the development cost of GTA 6 getting the game ready for launch. A similar story is reflected if we look at the debt of the company. It's remained quite flat, right? And then it jumps up sharply in 2023 and 2024, where the company seems to gather additional cash to finish the development of GTA 6 in time. Now, one of the benefits of increased debt is that the excess cash in the same time period has remained quite flat, even though they've of course developed GTA 6 and acquired Zynga. The market cap has grown at roughly 14% per year. That's in line with the revenue growth of roughly 15% per year. And the enterprise value, which of course is the market cap, plus the debt minus the excess cash, has grown slightly higher at 20% per year. Here we have a few additional ratios. We have the enterprise value divided by the EBITDA. we can see that it's been 22.7 times on average over the past few years, and that's excluding the red numbers. The EBITDA margin has stayed at around 20% on average, excluding the minus 34%. We can see also a dip here of 11%, but that's also included in the average. And the debt to EBITDA, it's mostly NAs, right? Because in the case of debt, we're reducing the excess cash from the debt to calculate it. So it's usually not been an issue, right? We can see 1.6 times here as the highest one, but it's become an issue when the EBITDA is negative, right? It's NA here, but that's a huge red flag as well to keep in mind in analysis. Now we've gone through the enterprise value data. Let's go through the free cash flow to equity data as well before we get the price targets for each of them. So here we are back in the model, and the relevant table now will be the one here below for the free cash flow to equity. And the free cash flow to equity, in a sense, is the relevant cash flow for us as equity investors. And we'll start with the operating cash flow adjusted for share-based compensation. We can see it's remained quite flat, but the same story continues. It dropped in 2023 and in 2024, being negative both years, of course associated with higher development costs for GTA 6. CapEx, on the other hand, has been quite flat. Nothing really stands out, just 100-200 million per year. And the net debt payments, we can see a positive payment of debt, right, in 2023, which is good for us because that's additional cash for equity investors. Of course, this increases the amount of debt. We have shares outstanding growing roughly 11% per year. So you as an investor get roughly 11% diluted each year. Now, this was not an issue in 2020 and 2022 or 2021, in these 3 years. But of course, the same story continues. The company is raising cash to develop GTA 6. So the shares have really spiked in the last few years. The average share price has just been 2%, right, over the past few years. And this is a story of share dilution, right? But also an increased market cap as well. So the average share price hasn't really risen that much over the past few years. Now, if we look at the actual free cash flow to equity, we can see that the formula uses the adjusted operating cash flow that we have in the column to the left. Then, of course, it reduces the capex, and then it adds any positive or negative debt payments that the company has made over the past few years. So the free cash flow to equity has been quite resilient, but it's been all over the place, right? It's been helped in 2023 by the positive inflow of cash from debt, but it's been all over the place, negative, positive, and all of that. So it hasn't really been consistent over the past few years. So the same story is applied to the free cash flow per share. It's been all over the place, and the free cash flow yield has been on average 2% per year in this time period, and the free cash flow margin has been roughly 10% in the same time, which is of course the amount of free cash flow divided by the total revenue. So we've gone through the historical data that we have of Take-Two Interactive. So let's jump into the fun part of the analysis, which of course is the stock valuation. And starting off with enterprise value price target, we'll focus on this table here to the left. And what we're doing is that we're using the revenue from the past year and applying a growth rate for all the future 10 years that we're forecasting. So we can see plus 5% for this most recent fiscal year, which will end quite soon here in March. And then we're applying 94% growth with the launch of GTA 6. And then we have minus 54, plus 31, plus 26, etc., etc. Now you might ask, why in the world are you using this type of growth rates? And that's an excellent question. But in our case, I'm using actually the historical revenue growth looking at when GTA 5 was released. We can see here that it spiked 94%. The same growth rate I've applied for GTA 6 coming next year for Take-Two Interactive. We can see another big spike, and that was the launch of Red Dead Redemption 2, the second major franchise of Rockstar Games. So having looked at the table, we're using the same growth rates that we had gathered previously. The only difference here is that I'm extending the time from GTA 6 and the time for Red Dead Redemption 3 a few years. That's going into the recent theme of longer development times higher development cost as well. With that said, we're applying a EBITDA margin of 20%, which was the average that we looked at before, right? And we'll also apply a long-term market multiple of 22.7 times, which is also the average that we saw in the analysis before, right? If we backtrack the enterprise value formula, we get a market cap of roughly 78.3 billion. With all of those assumptions, we get an enterprise value price target of roughly $375.9 US in 2034. We'll also look at the second price target, which uses the free cash flow to equity data. In this case, we're assuming a long-term free cash flow yield of 2%. That's also the average that we saw in the analysis. And a year zero free cash flow per share of minus 2.7 US dollars per share, as we see in the latest data that we have. Using those assumptions, we get a free cash flow to equity price target of $624-ish per share. And as we have both of these price targets, we're weighing them equally, right? 50% each, and we get a weighted price target of around $500 US, 10 years ahead in time. So before we go to the summary, I'll just do the quick DCF of the company as well. Now, the logic here is that we're using all of the future free cash flows and discounting them to a present value of today, right? Using the discount rate of 9.3%. Using all of that data and analysis, we get a fair share price of $316. With that said, here's a summary of our annual return calculations and the free cash flow per share. We get the fair share price of $316. That's a 50% discount versus the current share price of $210. And the IRR becomes around 12% per year. That's the estimated compounding return as we as investors can expect each year being produced by the stock. Now we have a sense of where the stock lies in terms of its fundamental or intrinsic value. We have a fair share price and we have an estimated annual return of 12% per year. So let's give this investment just a final rating and conclude, is this something that we should potentially invest in or something that we perhaps should stay away from? So as a final rating for Take-Two Interactive, I've given the company 4 out of 5 stars. I'll go through just quickly the key criteria I have rated the company in, and I'll just give some comments on why it has received the score it has received. If we look at revenue growth, yes, it has been quite strong and quite resilient. I've given them 4 out of 5 because the revenue hasn't really fallen apart. Despite, Red Dead Redemption and GTA 5 not releasing in the past few years, the revenue has stayed quite resilient, which is to me as an investor a positive sign. On the other hand, if we look at EBITDA growth, it has not been strong. In fact, it has fallen apart quite sharply in the last year, right? It's become negative. So that's a no from me. The free cash flow growth is here as well, not been really that resilient, Looking at the debt, of course, it's not below the debt to EBITDA. It's not below 3 times, which is what we're targeting. So here again, it's another risk for us as investors. Now, with that said, there are some bright spots in this rating, right? We have a high RRR versus the expected market return. It's not a crazy 5 out of 5, but it's higher, right? It's 12%. It's higher than the 9%. And given where stocks are right now, valuations, the market, and all of it, I think it's a really good expected market return as long as you're beating the market, right? That's what we're trying to do. Is it well priced versus its fair share price? And I think it really is. It's 5 out of 5 here in the score. It's a yes. But, to mention again, this assumes that GTA 6 will become a huge success, right? And that's a big if. If you're, on the other hand, with the other opinion that GTA 6 might not become a huge success, then I wouldn't apply the same growth rates and I wouldn't give the same score to the fair share prices I've given here as well. It's a strong competitive positioning. I would say yes, that's the big one. If we look at the comments of other gaming companies and studios, their CEOs are scared about GTA 6. They can't predict when they will launch their own games. They're staying out of the way, right? To me, that's a big indicator that yes, Rockstar Games and Take-Two Interactive have a strong competitive positioning. Other competitors are quite afraid of their games. They're assuming that if GTA 6 is being launched at any given date, most gamers will prioritize that game. They will play GTA 6 first and above of any other game that's being launched in the near time of GTA 6. Another metric is strong brand reputation. I want a company that has a strong brand, of course. Rockstar Games has arguably the strongest reputation of the entire gaming industry. Now, this is subjective, of course, but in my opinion, they have a reputation of excellence. They have a reputation of strong attention to detail, and that's why it takes 12, 13 plus years to develop just one game. Lastly, another metric we have is the legal and the macro risks for the company. Are they low? In this case, I would say yes. They're not producing physical goods, cars, or anything like that in China, which currently have a lot of tariff uncertainty. That's a positive for us as investors, of course. They're also not in the radar for any kind of antitrust regulation from the EU or the US, as we can see a lot from looking at Google or Apple. They are constantly being fired with these type of legal risks. We also have Amazon there as well. So, is Take-Two Interactive stock undervalued today? Well, I would say yes. I mean, I would say that if you, like me, assume that GTA 6 may become a huge success, then the company is undervalued. Then you may also expect market-beating returns in the coming years if you hold the stock for the long term. Now, with that said, there's a huge risk here. If GTA 6 does not perform well, then really there is nothing in the company's balance sheet or portfolio of companies or gaming studios that can make up for that kind of lack of performance, right? It's all on GTA 6. That's all that matters, right? So thank you so much for watching this video. As I mentioned in the intro, there's a free one-pager. If you go down to the link in the description, there's a one-pager that summarizes the 5 years of financial data used, the full discounted cash flow assumptions, and the forecast summary. So yeah, please like and subscribe. If you have any questions, please write them below and I'll get back to you as soon as possible. Thank you so much and see you in the next one.